A mountain of debt, Japan's economic puzzle. Japan, a nation renowned for its technological prowess and economic might, stands at a crossroads. The country faces a daunting economic challenge, a staggering national debt that has ballooned to over 260% of its GDP, the highest among developed nations. This issue, often referred to as Japan's debt time bomb, poses significant risks to its long-term economic stability and global standing. Imagine a family spending far more than it earns, year after year, accumulating a mountain of debt that seems insurmountable. This is the reality of Japan's fiscal situation. The implications are far-reaching, impacting everything from social welfare programs to infrastructure development and ultimately, the future prosperity of the nation. Understanding the causes and potential consequences of Japan's debt crisis is crucial not only for policymakers in Tokyo, but also for anyone invested in the health of the global economy. As the world watches closely, Japan's ability to navigate this challenge will have profound implications for global financial markets and serve as a critical case study in debt management for nations grappling with similar issues. The perfect storm understanding the roots of Japan's debt. The roots of Japan's debt crisis are complex and multifaceted, stemming from a confluence of factors that have plagued the nation for decades. One key driver is the prolonged period of economic stagnation, often referred to as the lost decades, that followed the burst of Japan's asset price bubble in the early 1990s. This period of sluggish growth led to chronically low tax revenues, making it increasingly difficult for the government to cover its expenses without resorting to borrowing. Compounding this issue is Japan's rapidly aging population, a demographic trend that puts immense pressure on social security and healthcare systems, further straining government finances. Adding to the complexity is the issue of deflation, a persistent decline in prices that has gripped Japan for years. While falling prices might seem beneficial at first glance, deflation can create a vicious cycle. It discourages spending and investment as consumers and businesses delay purchases in anticipation of even lower prices in the future. This further dampens economic activity and makes it challenging for the government to generate revenue through taxation. Abenomics, a double-edged sword for Japan's economy. In response to these challenges, former Prime Minister Shinzo Abe introduced a series of economic policies known as Abenomics in 2012. Abenomics aimed to revive Japan's stagnant economy through a three-pronged approach: aggressive monetary easing, fiscal stimulus, and structural reforms. While these policies have had some success in boosting economic growth and combating deflation, they have also contributed to Japan's growing debt burden. The Bank of Japan, under Abe's direction, implemented a massive asset purchasing program, injecting trillions of yen into the economy. This unprecedented monetary easing, while intended to stimulate lending and investment, has led to a significant expansion of the central bank's balance sheet and increased the risks associated with Japan's debt. Furthermore, the government's commitment to fiscal stimulus, including increased public spending and infrastructure projects, has added to the national debt. While these measures have provided a short-term boost to the economy, they have also raised concerns about long-term fiscal sustainability. Section 4. Living on the edge, the risks of Japan's debt burden. The consequences of Japan's unsustainable debt levels are far-reaching and pose significant risks to its economic future. One major concern is the potential for a sovereign debt crisis, a scenario in which investors lose confidence in the government's ability to repay its debts, leading to a sharp increase in borrowing costs and potentially triggering a financial meltdown. While Japan has so far avoided such a crisis, thanks in part to its high savings rate and the fact that most of its debt is held domestically, the risk remains a constant threat. Another significant concern is the crowding out effect, where government borrowing to finance its debt crowds out private investment, stifling innovation and long-term economic growth. This occurs because high levels of government borrowing can drive up interest rates, making it more expensive for businesses to invest and expand. Moreover, Japan's high debt burden limits the government's ability to respond effectively to future economic shocks, such as a global recession or a natural disaster. With limited fiscal space, the government's ability to provide stimulus measures or social safety nets during times of crisis is severely constrained. This lack of flexibility could have devastating consequences for the Japanese people and further exacerbate existing economic challenges. Section 5. Charting a new course: potential solutions for Japan. Addressing Japan's debt crisis requires a multifaceted approach that tackles both the symptoms and the underlying causes of the problem. One crucial step is to implement structural reforms aimed at boosting economic growth and increasing tax revenues. This includes measures to improve labor market flexibility, encourage entrepreneurship and innovation, and attract foreign investment. Another critical area for reform is Japan's aging population. Encouraging higher birth rates, promoting immigration, and raising the retirement age are all potential solutions that can help address the demographic challenges and reduce the burden on social security and healthcare systems. Alongside structural reforms, fiscal consolidation is essential. This involves a combination of spending cuts and revenue increases aimed at reducing the budget deficit and gradually lowering the debt-to-GDP ratio. However, achieving fiscal consolidation without stifling economic growth requires a delicate balancing act. Section 6. The Global Impact Lessons from Japan's Debt Dilemma. Japan's debt crisis serves as a cautionary tale for other developed nations grappling with similar challenges. The experiences of Japan highlight the risks associated with prolonged periods of low growth, demographic challenges, and unsustainable fiscal policies. As the global economy becomes increasingly interconnected, Japan's debt problem has implications that extend far beyond its borders. A sovereign debt crisis in Japan, the world's third-largest economy, would have significant ripple effects throughout the global financial system, potentially triggering a global recession and undermining confidence in the global economy. Furthermore, Japan's experience underscores the importance of addressing structural issues that can hinder economic growth and lead to unsustainable debt levels. This includes tackling issues such as labor market rigidities, low productivity, and demographic imbalances. Section 7. A Call to Action. The urgency of fiscal reform in Japan. Japan's debt crisis is a pressing issue that demands immediate attention and decisive action. While the challenges are significant, they are not insurmountable. By implementing bold structural reforms, pursuing fiscal consolidation, and fostering a culture of fiscal responsibility, Japan can chart a path towards a more sustainable economic future. Failure to act decisively will only exacerbate the problem, increasing the risks of a sovereign debt crisis and jeopardizing the well-being of future generations. The time for complacency is over. Japan must act now to defuse its debt time bomb and secure a prosperous future for its people. The world is watching, and the stakes are high. Japan's success in tackling its debt crisis will not only determine its own economic fate, but also serve as a critical test for other nations facing similar challenges in the years to come. The time for action is now.